Alright, I got a few complaints in the last video saying that the volume was too soft. It was too low in the previous video. So anyhow, still continuing. We're gonna go on to the next video now. I'm sure this might be too loud, but whatever. Just got this mic. Anyhow, so what we're doing now is we want to put out as much of the fundamental basics as to what I'm not even going to go into huge long lessons. That is for student to student. That is for the one-on-one, but yeah, otherwise none of that. Because really and truly, all that is ever needed is just the basic fundamentals. And I notice especially that I've had students going on years. They do well, but then what happens? Eventually they forget the basic fundamentals and they stray to doing this and that. So we're gonna go back to the basic fundamentals, and AUD USD last week gave us a good little lesson on that. I had students who were, selling from here, and then going in, going out, going in, going out, going in, and going out. Now, we're going to go back to one of our most basic principles, and that is never set an instant execution. Now that, of course, doesn't have to be indefinite. Definitely at first I say indefinite, because the problem is we don't understand why we do it. We don't, obviously, because there's no understanding as to why I say that there should be never any instant executions, is why people still do it at the wrong point, at least. All right, so we're going to go over a few things, and it's why does the market move? The most basic fundamental principle. Why does the market move? So, why does the market move? And step one, why does the market move, is it moves based on economic activity, the transfer of transactions from a country to the next, as well as economic indicators and like, for example, if you're buying into a stock, right? If the company reports good earnings, you want to naturally buy into that stock, because then, that's a natural course of things that will rise. So anyhow, so it's the same thing for countries and governments. They issue statements showing negative or positive results in the economy, and that as well increases volatility. Now, that's really just when the market moves, as well as when just simply the times in which the market is active. So traders are active. So traders are active for the day, and of course, when traders are active, that's as well when these economic events happen as well. So we need to find out when that is. All right, and then we have to find out what happens. Right? The way the market moves, and when we trade our inside bars, right? The inside bar really is a reflection of here. Shorter term consolidation. Now, the consolidation really is just a pause. The pause in the market really is the indecision, or the market is staying stable. All right. It can't, there's nowhere for it to go because there's no activity. Say for example, if you're trading USD CAD, right? At 12 o'clock in the night, Canada is sleeping, America is sleeping as well. Then, one sec. Yeah, so when Canada is sleeping, the US is sleeping, then of course there's not much to happen, because the banks are closed, the hedge funds are closed, the government is effectively closed. All right, so once we understand that basic principle, volatility equals the market just moving, right? And volatility is caused by economic activity, which is, of course, and there's an economic activity cannot happen when everything is closed, all right? So that's just the basic fundamental principle. The market moves when there's economic activity. Now, one would say, why don't we just trade news? Now, pretty much the market is moving on news, but why don't we trade news? Why don't we just watch news all day and just set our orders based on that? The reason being is many of the reasons. All right, for the most basic principle, the most basic reason is that by the time the news hits the media, the deed is already done, the market has already moved. So that's the most basic thing. All right. Secondly, you cannot see in depth as to what's happening. You cannot see as much in depth as to what is happening in the news, because you can only know what happened, the result of it. But you know, the true response the market has had, the true preparation and response you would not have seen if you were only trading the news. So the reason why we trade technicals is we can see it all right? We can see the preparation, the before, right? The before the volatility and the after the volatility, right? So this, when the market is trending, right, and it forms an inside bar, which is a sideways movement, this is the interim before the volatility comes and the market gives its idea of whatever is happening. Now, based on the previous pattern of the market, that will tell us what most traders are expecting. You know, the hedge funds are expecting as to what the result is. All right, and no, we're not Nostradamus, we can't be right. It doesn't necessarily have to be that way. Therefore, we have to set pending orders, all right, in preparation for it to be our way. Now, it doesn't always have to be our way, and not just because it looks like it happens the same way all the time means it's going to happen like that. So we're not Nostradamus, we can't know for sure. So if what happens then, if the market is trending, it looks perfect, but it breaks out and boom, falls, or well, not breaks out and boom, falls, but instead of breaking out, it breaks down this way. And if it fakes out, then there's another reason for that. We'll get into that in a bit. But if it falls down, then if you had set an instant execution, you would just have 9 out of 10 times you will lose on an instant execution, because you can't know for sure. You can only set in preparation. It's like, as I always used to say, the meteorologist, all right, this is the Caribbean, the islands here, Haiti, Jamaica, Cuba, right? Now, when a hurricane is coming along, all right, a tropical storm is coming along, we have many projected paths, right? Many projected paths. Now, the reason why there is the projected path is the way, the direction in which the wind is blowing, right? The jet stream, I can't remember the exact name. The way in which the wind blows is to the west and then up, right? And that is why we see the general direction of hurricane is that way. Now, we don't know whether it's going to hit Haiti, it's going to hit Cuba, it's going to hit Jamaica, or it's going to pass below Jamaica, or it's going to pass above Jamaica, or it's going to do whatever the hell it wants to do. Now, we don't know if it's right here, but as it comes along, all of these projected paths get smaller and just a few. Instead of it being 5 projected paths, maybe 2, and as it comes along, you know, just 1, right? So what this means is that we cannot know for sure what's going to happen in the market. But if we prepare for it to break in a certain direction, just like we prepare for the many instances, five projected paths here, then if it actually does hit Jamaica, we would have been prepared for that. All right? If it hits Cuba, Cuba would have been prepared. If it hits Haiti, Haiti would have been prepared. All right. So that's all we are. We are analysts and we prepare for the market. Otherwise, it's all gambling. If you are trying to if the market is just moving up and down all day and you're setting instant executions, it's all gambling, because the market it has to move up and down. It's just it's volatile on the short term. It has to fluctuate up and down because the market has to be ever moving. It can't just stay in one place all day. It has to be moving. So to bet on that is pretty much gambling. All right. Only if you really know, you really have your money management down to a T, can you really do something well with that, and that takes discipline as well. So that's for another time. So now you might say, what happened to limit orders, right? Now you might say, what happened to limit orders? If we have a slowdown in momentum and we have a sell limit here to rise and then come down, right? Why is that? Now, the reason why we have a sell limit is that the market has already pretty much prepared, right? It's like, for example, if you're shipping something via FedEx, right? And you buy something on Amazon and your Amazon says 1 day shipping, it will arrive tomorrow, right? As soon as you click that order button, there's a preparation for it. So they prepare it, and then nothing happens. They prepare it for shipping, and then nothing happens until the next day when it ships. So when the market prepares like this, right? This is the market pretty much saying, all right, this is the whole economy saying, all right, tomorrow, a couple days from now, we'll go in this direction, because that's how we're setting up for it. We're preparing for it to go into this direction, but we're going to sleep now. So till then, the market's going to fluctuate, right? So till then, you'll have, and as well, the market wants to increase liquidity to have that fluctuation. Like, for example, if before you take off in a plane, you got to fuel it up. Now, within the point in which the market comes from here to here, there are many retail traders from everywhere in the world, Indonesia, all those third world countries all over the world. They're racking up positions. They're trading the short term. They're trading the 10 minute, the 15 minute, the 5 minute, and they're setting buys. They're setting sells from here, and their stop losses right here. So the market has to move in the opposite direction, at least for a little while, up to the previous support, so it can pump money, right? Pump money into the market, so that when the market falls, and all the hedge funds, all the banks are profiting, there is somewhere that the money is coming from. Because at the end of the day, if $5 trillion are moving throughout the market each and every day, it's got to come from something. Every time I lose money, every time you lose money, it goes into the market, it goes to somebody else. All right? And therefore, market liquidity, the concept of market liquidity is, whoops, I just downloaded this game. Let me pause it real quick. Yeah, so the concept of the market liquidity, it has to be liquid, it has to be flowing, it has to keep flowing, but there has to be something contributing to it, right? And the traders are what contribute to it. If you look at the basic principle of stocks, the basic principle of stocks is the more volume is going into the company, of course the company value rises. The less that comes out, the company falls. Right? So the more small traders that are buying, there's millions of them buying, they're pumping money into the market in preparation, and then boom, their stops are being taken out, and then the market falls, and then the market opens, right? And then the market falls, and all the hedge funds and all the banks are profiting. All right, so you might say, all right, Zain, if the market reaches up to here and you see a signal, right? A class 1 signal, should I set an instant execution? Yes. Now, still would recommend you put the stop a pending order at the 0 level of the pin bar. If there is an H4 pin bar at the shoulder level, still recommend you put a pending order. We don't want to get into the habit of instant execution because it goes back to the issue of temptation and discipline. It's better to avoid the fire than play with it and then eventually get burnt. Because the more you set instant executions, is the more you are building that temptation to just click buy sell all fucking day. So don't do that. So that's why we really need to understand why we set our pending orders. And the simple reason is we cannot predict the market. We can only know what the market is preparing to do and respond to it if it does it. Now, we don't know if it's going to do it. So we have a stop, we have a sell limit there for a smaller amount of pips. Our hope is that it hits it and come back down, because that's what, not really hope, but that's how the market is preparing itself. And then, of course, if you want, you can have a stop order there. That is confirming that the market is breaking, and when it breaks, it's going to move into this direction. All right. So you're not predicting anything. All right. And at the end of the day, even when we're preparing, we still don't have a huge chance of winning, of it going our way. Even with our preparations, we don't have a huge chance. That's where money management comes in. So if there isn't a whole lot, right? Imagine if we're just setting instant executions. When you set an instant execution, your chance of it going your way is 20% off the bat, not 50%. Right? The reason why it's not 50% is if you had to enter and enter in was the only thing you had to do, then it would be 50%. But you have to close as well. So that 50% cuts in half to 25, and I say even take it down a notch to 20%. So that's your chance of winning every time you set an instant execution. All right. So if you don't know your proper money management, then you're screwed. Now the good thing about setting pending orders is it gives you as well the peace of mind to just to have your shit in order, have your shit planned, have your business planned, right? You're planning out the trade, you're planning out the future of the trade, you're planning out everything, and you can sleep. All right, you've planned out your risk. When you begin to instant execute too much, that's when you begin to impulse, and that's when you begin to set trades without preparing risk, reward, and the probability. The moment you forget risk, reward, and probability, you're screwed. All right, so this might seem simple, but it is as important as it will ever get. There is nothing more important than understanding and knowing this. Never set instant executions. All right. Another thing is if you're this idea of don't mess with the fire. It's easier to avoid the fire than getting burned. If you do this more and more, you'll be able to have class one. You'll be able to be more patient and wait for class one high probability trades. And when you wait for class one high probability trades, anywhere from 65, 70 to 85% of your trades will go your way. And we don't really need that much for it to go our way. We need at least 20% for it to go our way for us to make money. If it goes that way on the long term, right? And it gives us scale ups and it gives us confirmations. No, anyhow. So that's it. All right. So no instant executions. There's so much more I could go into as to how important this is, but I don't want to make the video long. So it's 19 minutes now. Last words would really be, just don't do it. Just don't do it. All right. You'll be able to prepare better. You'll be able to your emotions will have far less. You ever set an instant execution and immediately you're not very sure of it, and the market is fluctuating, and you're watching the market go up and down, and you're watching that makes no sense. You're better off setting a pending and it breaks. it triggers it when it breaks, and it just continues in that direction. If you set a pending order very nicely on a breakout properly, a good amount of times, well, I won't say majority of times, it will just hit it and break and continue in that direction, and you won't be in loss for a very long time. Now that does a lot on your emotions, and you wanna focus as much as possible on limiting the amount of emotional trauma you have to go through in this. The more you limit, the more you take care of yourself, is the more money you'll make. But if you continue to shoot yourself in the foot by continually practicing things that will screw with your head and screw with your emotions, then you're fucked. End of story. That's all.